bond portfolio managers who don't use ETFs turn to futures, bond
Yeah.
futures. How are bond ETFs better than futures? Are they better, and how are they better?
Sure. I'd never go so far as to say things are better.
Okay.
Things are different, and they have different applications. So first off, bond futures exist only for the government curves. Right? You can't, there's no such thing as a credit future. There's no such thing as a broad hard currency emerging market debt future. So Treasury futures versus Treasury ETFs, pretty similar. The big difference is that a 10-year future gives you the right to get a 10-year bond. Most ETFs are 7 to 10-year, 10 to 15-year collection of bonds. So inside an ETF are actual physical cash bonds, and in the Treasury space, the curve profile might be a little bit different. There's also, of course, a fee on a government bond ETF and margin on a future. In the credit space, it's quite different, right? In credit, you have a CDX contract. And the big difference there, other than leverage, other than the fact that one is a derivative and the other is, again, physical, is that CDX has basis risk versus a cash bond portfolio. Right? So if you're trading CDX, you're getting exposure to 125 cash bonds, and you have to roll the contract. Our investment-grade credit ETFs hold 1,500 bonds and have a correlation of 0.99 to the average index. So if you're looking to hedge, our finding has been that actually CDX is a less than perfect hedge for a cash bond portfolio in times of stress. It's perfectly fine when there are no issues, but when the markets are stressed, the CDX to cash bond basis risk is quite large. ETF is cash bonds, so it doesn't have the basis risk. The global bond ETF market is about $500 billion in size, and just at iShares, we have 200 bond ETFs. The global number is probably close to 600 or 700 now. So there is some variety. But I'd be lying if I said that every single one of those ETFs is hyper-liquid and has a place in every single investor's portfolio. Right? Just like every new instrument, some make sense, some don't make sense. So what are the uses that we've seen to be the most popular and the ones that really generate the most savings or liquidity for our bond clients? Quickly transitioning out of one market into another. Right? So if you, for example, believe that US high yield will tighten, but you don't think you have enough exposure, it will take time to buy the cash bonds. So you could buy a high yield bond ETF and capture the spread tightening through beta. So an ETF is perfect for that. It's much more efficient to buy the ETF. Just to give you a sense, our US high yield ETF traded $1 billion a day 10 times during October. So if you needed to put on $500 million worth, it would take you 2 days maybe. How long would it take to do the same trade through cash bonds? Now, Asia high yield, different. The ETFs that exist don't trade that much. So they don't serve the same liquidity purpose. But the purpose that they do serve for our clients is that when an inflow happens into one of our less liquid ETFs, then it's the BlackRock dealing desk that works with broker-dealers to execute the bond trades. And it's probably a safe bet that the BlackRock dealing desk is more efficient than a large variety of our clients' dealing desks, simply because of its sheer size and ability to execute. So when our clients use our Asia bond ETFs, they're basically renting our execution capacity. And they're saving money versus the bid-ask spreads they would get.